Warren Buffett is a businessman and investor, CEO of Berkshire Hathaway Investment Company, has a net worth of exactly $113 billion and is the fifth richest person in the world. Warren Buffett has amassed incredible wealth by making sensible and stable investments throughout his life. Like any small investor, Buffett started from scratch, buying some Coke-style drinks as a kid and selling them for a profit of 50 cents when he was about 12 years old. Later, he built his wealth by entering different businesses. Buffett continues to make investments and build and grow its wealth by adhering strictly to its investment principles for years. Now I will share with you some of the Warren Buffett principles that played a huge role in Warren Buffett's $113 billion wealth. Invest in companies you understand. Buffett says it's important to always invest in companies and institutions where you understand their business models, operations, systems, and future prospects. He emphasizes that you should avoid investing in companies, ecosystems, industries, and markets that you do not understand. Reducing the sector pool to be invested in and investing by focusing on certain sectors will increase the investor's experience in that sector, so that the investor will not divide his experience by focusing too much on various sectors, but will gather in a certain area. Warren Buffett warns us about this issue and tells us what kind of method he has followed and how he has grown his wealth so much. Focus on long-term perspectives. Rather than making short-term investments, Buffett prefers to make long-term investments in companies that he believes are successful and that he believes the company will be in a better position and can develop in the future. Thus, while short-term investors are affected by short-term fluctuations in stock prices and make panic selling or false sales, Buffett is not affected by these short-term fluctuations and can better focus on their long-term goals. Avoid debt. Investing by borrowing is a form of investment that Warren Buffett usually does not practice and avoids. Instead, it focuses more on cash flow-based investments. Let's take an example. Let's say you borrow $10,000 and you're going to pay it back $1,000 every month for 10 months, and you use that $10,000 as an investment. If this investment is as you predicted and you make money, you can cancel your investment and pay back your debt and you will be in profit today. But if your investment doesn't turn out the way you want and you want to wait for the falling prices to increase, the situation gets dire if you can't pay the $1,000 you have to pay monthly. You may have to spoil the investment and make a loss. Warren Buffett generally preferred to avoid debt because he knew the possibility of these events happening to him. Invest in companies with competitive advantages. Buffett has adopted the principle of investing in companies with strong brand recognition, built on solid foundations and able to compete with other rival companies. We can say that companies that cannot compete with rival companies and dominate the market are not very suitable for investing. Spend less than you earn to build wealth. This may sound simple most of the time, but many people give in to their whims about it. It is essential to plan your budget and expenditures and to invest a part of the budget regularly every month to increase your wealth. Reducing expenses and saving as much as possible, saving money instead of unnecessary shopping are examples. It will be beneficial to have assets that can generate income continuously and to include these assets in your investments. Let's face it, if you examine Warren Buffett's capital growth chart, you'll see that he's not consistently winning, and he's been losing money some weeks and some months. This is actually quite normal, but new investors see it as a minus and panic as they are constantly trying to increase their wealth and focus on the amount of money. Warren Buffett has always made a profit in the long run while increasing his wealth and making money on his investments, but he has also lost a little money in some short-term periods. During these periods, he did not panic and followed the plans he made and waited for the price ranges he had targeted. Be patient and disciplined. All other great and successful investors like Warren Buffett have in common that they are patient, disciplined, and consistent. All experienced traders know that successful investments take time and patience. As always, small and inexperienced traders go after short-term uptrends, jumping from branch to branch and losing money. But experienced investors focus on long-term trends, try to see the future, and make their investments in this way. Time is the tool that requires the most knowledge and experience to use while investing. Stand out from the crowd. Another key element of building wealth is to stand out from the crowd when investing. The reason for staying away from the crowd in investments is that the crowd, that is, most people who invest, make wrong investments and make wrong decisions. Most of the investors are ignorant and they make their investments not professionally, but leaving their business to chance. Warren Buffett was buying shares when most investors were selling their shares, and selling shares when most investors were buying shares. Getting away from the crowd and making the moves you know right sometimes leads you to build wealth, not loneliness. Invest in management. Buffett believes that the management of a company is a crucial factor in its success or failure. It talks about how far an experienced and successful management team can take the company and develop it. We understand from this that when investing in a company, we invest not only in the general characteristics of the company, but also in the company's managers, administrators, personnel, and all other employees. Be careful about the accuracy of the predictions. Even Warren Buffett, one of the biggest investors in the world, checks his predictions many times when investing. Buffett is always skeptical of forecasts and advises beginner investors to research and focus on the basic building blocks of the company they are investing in, rather than relying on short-term forecasts. Avoid diversifying your investments too much. Buffett warns investors that over-diversifying investments can lead to too much risk. What we understand from Buffett is that we should not make investments too little or too diverse. Ensuring investment diversity is of great importance in terms of the risk ratio of the investment. Building wealth is like building an apartment. The main element that makes the apartment solid is the foundation of the apartment. An apartment whose foundation is not solid even if it looks solid from the outside. The foundation of wealth building is the perspectives used by Warren Buffett and other successful investors. When Warren Buffett is asked how he builds his wealth, he likens it to making a snowball on a hill and rolling it down the hill. Creating the snowball at first and trying to grow it by rolling is the most difficult part of this process. When you bring the snowball to a certain level and roll it down the hill, that's when you build the real wealth. In summary, Warren Buffett's investment philosophy is based on long-term thinking, analyzing and understanding the fundamental building blocks of companies, and shaping investments by creating a diversified portfolio in a particular industry. In addition, patience and discipline seem to be among Buffett's indispensable suggestions. Despite his wealth, Buffett lives his life very simply and modestly. Presumably, if anyone had this wealth, he would buy himself the most luxurious things in the world, own the most luxurious cars, houses, yachts, helicopters, and planes in the world. But Buffett prefers to stay in the detached house he bought in 1958 and gets into a car that can be bought by a middle-income person. Buffett's lifestyle and perspective on money may seem strange to most people, and you may even doubt Buffett's sanity. Don't make such a mistake because the person we're talking about is one of the most successful people in the world. In my opinion, understanding Warren Buffett's strategies, philosophy, and thinking is crucial to being a good and successful investor. If we can understand the thinking of a genius like Warren Buffett, we can look from his point of view and make investments like him. I know not everyone can be Warren Buffett, but even someone with Warren Buffett's 1 in 100 or even 1 in 1,000 success can become a millionaire or even a billionaire. That sounds great. At the end of the day, all that remains is to be able to look from the point of view of millionaires and act like them. I wish the information I share with you will be useful for you and you can make successful investments like Warren Buffett. Don't forget to subscribe to my channel and comment below.